Hi, everyone. Thank you for joining our webinar today. I'm just going to give about a minute or two for people to join, and then we'll get started. If you want to, while we wait for other folks to join, feel free to use the chat function to introduce yourself, tell us a little bit about your business if you have one, any information that you might want Jen to know. Yeah, feel free to use that chat function as we wait.
Thanks for moderating that chat for me, Emma, too, because I can't see that.
Yeah,
Nor
no problem.
the gallery of anyone who's on. So
Okay.
just keep me posted.
Yeah, we'll do. Sorry, that's our doorbell going off.
I can't hear it. That's okay.
Oh, really? Oh, okay, good. It's quite loud in our office, so I never know how loud it'll be over Zoom.
Okay. My squeaky chair is really bothering me, but I hope you can.
Okay, I can't hear that either, so
Okay,
we're all
great.
good. Okay, well, I think that we can kick things off, and maybe a couple other people will join. So hello, everyone. Thank you again for joining us over your lunch hour for our webinar today. My name is Emma. I'm operations support here at WESC in our Regina office. I'm covering today for Tanya, our program lead, who usually fulfills this role of hosting the webinar. Our topic today is building confidence for female investors, presented by Jennifer Glavis from Research Capital. If you have any questions for her during the presentation, please feel free to use the Q&A box. You can also use the chat box for, again, to introduce yourself, any other comments. We just ask that if you have any questions, you do use that Q&A box. After, every few slides or so, Jen will kind of check in on us and see if there are any questions. Yeah, so anything at all, please feel free to drop in that box. This webinar is being recorded and it will be available for on-demand viewing. You'll get an email tomorrow at this time, so at noon, with a link to the recording. So you can give it a watch over if there's anything you've missed or you want to go back to. Yeah, you can watch it on your own time. So with that, I'll pass it over to Jen and we can kick things off.
Thank you, Emma. Thanks, everybody, for joining. This is amazing. I love talking about women and wealth. Thank you to WESC for bringing me on as a speaker for this two-part Zoom presentation looking at women and wealth, hot topic. I've got a lot to share. And I've got 29 slides that we're going to go through in 45 minutes. So like Emma said, I'll check in with her every few slides to see what's kind of cooking in the chat for questions. I can't see that. So don't be shy. I'll wrap up at about 12:45 so we can save some space for more Q&A if there is that. And then you can get back to your business. So women and wealth, hot topic. There is so much interest in this topic and no doubt as to why. There is a tidal wave coming of assets transferring to women, assets managed by women. And so, I mean, right now, we're no slouches to start right now. We already manage 2.2 trillion in assets, but there's more coming. So by 2026, women will be controlling 50% of all financial wealth in Canada. So the future of finance is female. And what's driving this change? So we're seeing a pattern of women outliving their husbands and partners. Okay, and we see more and more females earning more and learning more. and there's more women with post-secondary degrees, and there's more women participating in the workforce. We see more professional women with positions of management and leadership, and an increase in female entrepreneurship. So no big deal, right? Earning and learning more and more. Plus, this is a biggie, we've had a huge demographic structure of the population being the baby boomers, right? Their cohort that has generated and accumulated wealth at an unprecedented rate. And it's grown to unprecedented levels. So now we will see wealth pass to a spouse and then even maybe to a daughter within the same decade. So there's money in motion with women as the beneficiaries. So it's through divorce or through inheritance. And women of all ages are expected to benefit disproportionately from the transfer of wealth over the next decade. So, I mean, that's good news, right? But it is crucial that women be properly equipped to preserve and protect and grow their assets with confidence and independence. That doesn't mean in a silo on their own, but with professional advice directly to their queries. Okay, at some point in our lifetimes, 90% of women will be required to play the role of sole financial decision maker. So if you're not used to it, it can be a real shocker. So I want to remind you that a fearless woman's mindset can be a huge game changer. Huge. So since becoming licensed and dangerous for me back in 2019, I'm on a mission to share what I've learned, because information is power and everyone needs financial clarity. So my passion is to help my clients make confident decisions, and those can be made once you understand your options. So women like you. So let's dig into women and wealth. So these top 3 questions is where we were at the first presentation, and that is available in the WESC Resource Library. So you can go back and view that. We tackled those first three questions. And so today, we're in the second part here. We're taking the position that, yes, you have investable assets. Now what? Okay, what are all my options? And as a business owner with employees to recruit and retain, what can I do to help lower their income taxes and help them save for the future? Okay, and then there's 4 case studies I'm sharing of women and their investing styles for them to suit them in their 20s, 40s, 60s, and 80s. Okay, cruising. So one moment to just identify the difference between saving and investing. Okay, savings is short term. And it's the point of saving your life money. Oh my God, money. So keeping it close and have the discipline with that and not spending it. So the reality of that is that's you making deposits into the bank. Okay, you're working for the money. Okay, the drawbacks are there's going to be some bank fees. That's the banks, right? This money isn't supposed to grow. It's supposed to save your life. So that it will work against inflation. Okay, accept that. And if it does grow at the bank, there's going to be interest on that you've earned, and then they're going to send you a T5. So you're going to pay tax on that. It's also not associated to a beneficiary, but it's temporary money, 3 months of money. Okay, and then investing. This is where you're talking to a person like me, and you're taking opportunities in the market to grow at a much higher rate. Not to mention, we're looking at tax deferred or tax-free accounts, and also attached to a beneficiary. The point is to transfer tax-free or tax-deferred to a beneficiary. Okay, but there's a difference. And here's another recap from one of the tools that I shared at the presentation in May. These will be emailed to everyone as well, but I've got 2 of these. One is for the net worth annual, big picture, right? And this is what you track every year. And so you go through it line by line. I mean, this isn't new news. People have worked with a budget before. It's important, though, to keep track of your investments, because you can have them all over town, right? Or all over the country if you've moved, right? So find your statements, get all that mail, right? And figure out what have you got in your TFSA, your RSP, your spousal RSP, your LIRA. I'm going to unpack those, but just know what you've got as assets. And then as your liabilities, everyone's got them, right? But just don't get buried in interest. That's not easy to do, but you got to track it. Track your debts and your interest rates. Okay. Your net worth can change by not even making any more money. It's because you paid down your debt and you're paying less interest and you're worth more. So track it every year. If you don't have one, I have one. I'll help you with that. Budget. This is the monthly picture and it changes month to month, right? I really like how this is spread out. And I mean, it's every section, right? And in the miscellaneous section, I mean, the other things are kind of obvious, but in the miscellaneous, like the online subscriptions, right? Everything that goes along with just besides eating and keeping the car full and paying for the insurances and all the cell phones, utilities, blah, 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 right? And even when you're setting money aside to invest, that's an expense, right? Put it in the column as money going out, but it's going into an investment. But you don't know what you need to save for until you know what you need a month. So if you need $4,000 a month to live, to keep everything on, here's the simple advice: save 3 months of that. Okay, you need $4,000, save 12. Not easy, but it's possible. Okay, so that's my first piece of advice. And then once you know you have positive cash flow, okay, now what? So it's really important to have that oh my God money close, right? You don't want to have to take delays to call someone when you're in a panic to have it. So keep it close, keep it at the bank. People have mortgages, people have debts. Can you live within them? And are they manageable? Live in there, okay? Steady income helps, right? And knowing what you need and what's being covered. So it's not easy and it takes discipline, but you can get there. And then once you get there, what's the most efficient way to put fresh money to things? And what are all the accounts? You don't know unless, I mean, you can Google things, but then get lost in that too. But talk to a professional, figure out and prioritize. What do you want? What do you need? What's the point of this? And I can help you identify where to put that fresh money. Okay. So these are the RSP and the spousal RSP. These are tax deferred. Okay, tax-free savings account, no brainer. No brainer. $95,000 worth of backroom for each individual with a social insurance number in Canada. You can't do spousal on that. You can only work with your own social insurance number. First-time home savers account, that's tax deductible. And I am amazed with this account, you don't have to pay that back when you pull it out. That's amazing. That is amazing. So if you know you want a house, first-time home savers account's a good idea. If you have children and you want to educate them and pay for that education, and that's the only way I can guarantee 20% because the feds will help us educate our children to a limit, right? But RESPs, those are tax efficient, not deductible, but tax efficient, tax-free growth. So that's where you can put fresh money, right? Besides paying down your debt. Tax-free or tax deferred. That's the whole point. So once you find all your statements, right, and you've got an idea of what you got for investable assets or what you want, right? This is the area of accounts of where I live when I'm working with people and they're transferring their assets, which doesn't trigger a tax slip. Okay, transferring doesn't. Withdrawing does, but transferring does not. So a lot of times if you've moved a career, you're going to have pension if you've worked for somebody else, right? And that you've been lucky enough that they've paid into a pension account for you that's locked, okay? But you can access it at 55 years old. If the fraction of withdraw, or the formula, I should say, for withdraw is supposed to last you until 90. Okay, it's taxable income when withdrawn. It's probably the last money that you'll use, and it's what will pay your estate when you pass. RSP and spousal RSP. If you have a tax problem, contribute to RSP so you can bring down your marginal tax rate or your spouse's You're the higher earner, they don't make so much. You contribute it, they receive it in their account, and then they get the tax benefit when they take it out after 3 years. Gotta let it sit for 3 years. Tax-free savings account, my best friends, anyone's best friend. It's a no-brainer, right? And you get, if you need to take that money out for whatever, it doesn't have to be a house, it can be for whatever. You get that room back next year. So it's just a really clever way, and it's gonna grow each year by about $6,000 to $7,000. So count back to 2009, that's when it started. And then cumulatively, it has achieved an amount of $95,000. There are foreign assets like stocks, American stocks, if you hold them in a TFSA, and they pay you a dividend, you are going to have a 15% withholding tax on that dividend. Live with it. I mean, if you've got a whole principle about paying tax, then don't buy foreign stocks that pay dividends. But I can live with it. I'll take it. Okay, RESPs. That's the Registered Education Savings Program, and it's for children up to when they're 16 years old. You can receive 20% federal grant on $2,500 per year. So the maximum in grant money per beneficiary is $7,200. That's almost a full semester. But anywho, we'll take the help that we can get. I help people set those up for their kids, whether it's a family account or it's an individual account. First time home savers account, 40K. We can have appointments about these. They're a really good tool to use if you know that you want to buy a house. And then RIFs. This is when you're pulling money out. Yeah, your hand is forced with your RSPs and your LIR when you do turn 71. Now you have to start withdrawing it, but you don't have to wait until then, and you don't exactly have to take the minimum either. Okay, it's taxable, but that's tax planning. Okay, moving on. Simple tips to investing.
Sorry, Jen, can I
Yeah.
just, sorry, we just have one question about the last slide,
Okay.
if you don't mind answering.
Yeah.
The question is, do you get RRSP and TFSA at the bank or somewhere else?
You can have them all over town. The bank will want you to have it there, right? And the teller can talk you through as much as they know or as much as their license covers. But when you work with a professional, professionals know more. So I open RSPs and spousal RSPs and TFSCs all the time, and I'm either building them from scratch or someone has already established this somewhere else. And they're like, Jen, I'd like you to manage this for me. And then we transfer it. So I open them an account here and then we transfer it. Either in kind, you don't have to sell your assets if you don't like them. We can move it in kind or in cash. So the long answer to a short question is yes, I work with those. Yes, you can have them at the bank, but please don't just open an account with the first teller you talk to. I hope that answered the question.
Yeah, I think so. Thanks, Jen.
Okay. Okay. Okay, simple tips. Like I was just saying, educate yourself or talk to a professional. Okay. You don't have to become an expert, just work with one. And start small. Okay. $5,000 or so, right? Don't hold yourself to the penny to that, but that's a good sum of money to start with. Set realistic expectations. People might, say like, oh, I've got $300. Can you double it? No, right? Like, consider your real risk tolerance as well, the real risk tolerance. Pay attention, but don't get obsessed. I'm paid to worry and look at it and make the right decisions and figure out the why. Try to just let me do that. And don't let short-term volatility scare you. It's normal. It's normal for market cycles to fluctuate, and there is no one size fits all solution. Number 6, money can be like soap, right? Avoid moving your money around every time there's a change in the market, because you're just like, especially when there's fees, you're just grinding against that stuff. Set it, forget it, make changes when it's appropriate, but use a professional. Okay. 7, consider diversifying by asset class and global versus domestic balance. I mean, I have access to more things than just the general retail investor, right? So you can stay in Canada, you can go outside, but don't just have everything in one thing. And if you've got a few different things, don't think that just because it's different, it's diversified. Okay, avoid the overlaps. And talk to a professional if you've got like all the things and you're like, I don't know what I got. I've got balanced and growth, and what have I got? You probably got a lot of the same thing, and you're paying a couple few different people to push the same thing. So don't overlap. Okay, and it just takes pulling it apart, pulling the portfolio apart with a person like me. Okay, I'm gonna move on. Okay, here we go. This is the money shot here. Here's what I use. Okay, these are the tools that I use in those LIRA accounts, those RSPs, RESPs, TFSAs, on it goes. Okay, and we're kind of working in scale of risk. Okay, cash. We're starting on the left side here. Cash, you can't lose it. I mean, you can, but you shouldn't. I mean, you can grow it by working harder, right? But you can't grow your cash by, I mean, it sounds stupid, put it in the garden. That doesn't work. So cash is cash is cash, okay? High interest savings account. You're using a little bit of the market. The benefit is guaranteed because you know what you're going to get. You know before you go in. It's a high interest savings account. It's a 4 point something, right? Like 4 point low something. So there's very little risk. Costs really none, really none. So GICs, guaranteed because you sign up for, it used to be 5 point something, but now we're down a little bit more, which is actually kind of good news, but 4 point something, 4 point high something, right? Until this date. That's the benefit. You're welcome. That's what you get. Can't get out of it. Okay. Mutual funds. Just because you're in a mutual fund doesn't mean it's extremely low or extremely high. They're all going to be different. So read your fund facts. And know what the objective is of the fund and where it's investing. These really shouldn't cost much up front or on the back end. No, zero front end. But there will be a management expense ratio. That's the MER. That's the MER. Okay, management expense ratio. Nobody's going to work for free, and you're going to have to pay someone to make the decisions on that. So that's the management expense ratio. Okay. Mutual funds, they've been around a long time. Hybrid notes, this is juicy. This is juicy. Hybrid notes have been around for a long time by institutions. But now CRO advisors and our clients have access to these. And I'm going to dig through those a little bit more. But the reason I like them is because I pick them because there's a lot of monthly pay, right? And principal protected. Downside protection, minus 20%, minus 25%, minus 30%. I'll unpack that. And costs, doesn't cost the investor anything because the bank pays the fee. Okay, there is an early trading charge in ETC, and that diminishes after like usually about 180 days. And then you can say, hey, I don't want this income anymore. Let's sell it. Okay, no charge. And then there's stocks. Man, stocks are a really useful tool. You got to have the tolerance for it, right? Higher risk, higher reward, volatile, up and down. And people really want to time the market. There's a lot of psychology in that. And it's really just the time in it. As a retail person, I mean, consumer of it, you can get obsessed. And if you want to put your time into that, go for it. But anyways, yeah, it does take an eye on it. And there is a cost to it. If there's a cost to buy it, and there's a cost to sell it. And so that's just going to be a feature of it, unless you're in the type of account or you're working with an advisor that takes a fee of your assets. And then there is no trading cost. They're going to make money as your assets grow because you're paying them a fee. So these are the tools in order of risk. Okay. I bet you there's going to be questions on that. I'm going to keep going. Okay, oh yeah, I'm unpacking this. So GIC, typically for 1 to 5 years. Everything is covered by CDIC as well, which is a federal crown corp. Okay, savings for Canadians. It's protections for the savings for Canadians. So it's banks, federally regulated credit unions. No one has ever lost any money under CDIC's protection. It's a really great benefit that Canada has, and that's what our GICs are covered by. So you can't lose money. Mutual funds, okay, we're taking a bit of bite here in low to medium to higher risk. So for the average small investor, mutual funds can be a really smart and cost-effective way to invest. So there are companies that will, accept some monthly contributions as low as $25, right? It's usually around 100, but some will accept $25 per month on a systematic, ongoing basis, right? And you're contributing into a basket or into a pool, right? And it depends on who's pushing that basket and who's making the decisions. Some can be really low, or some can be higher risk. So look at the fund fact, please. Look at it. And realize that no one's going to work for free. I'll say that again. And so these are professionally managed. Okay. And that's what that MER is for. And you're going to pay that monthly, like it or lump it. You're going to pay that no matter what the market does. And you're paying that company and those analysts to identify the securities to buy and sell, and analyze market information and review it on a continual basis. So they're going to push the cart, and basically it's going to be through these sectors. Okay, these are stock sectors, but these are the same sectors that those mutual funds are shopping within, right? So they're pushing their cart down the communications aisle, the consumer discretionary aisle. Maybe they don't want the same bulk of everything. Okay, the asset allocation can get very, very, very technical, and you can get lost in the minutia, right? Of how much energy you want, how much materials you want, how much technology you want, and it sways a little bit. It can be cyclical, but you're paying someone to go down those aisles and make the decisions. And if I'm buying stocks, I'm looking at these sectors. Okay, this next slide, I really like this because it's a really good indication of where you can go in terms of market relativity, right? If you can play in the offense side and you don't mind watching things go up and down, you've got the stomach for it, right? That's your tech. Okay, that's your energy, that's your industrials. Defensive on that bottom left corner, right? No matter what's going on in the world, right? We still need our healthcare. We're still going to use our cell phone. We're still going to buy our toothpaste and our laundry detergent and our groceries, right? So I think that's I just like the visual of that to show the sectors. They're all in there, and one doesn't necessarily impact the other. You can have inverse relationships in some. But this is the defensive and the offensive side of the stock sectors. Okay. Does anyone have any questions here? I'll just take a quick pulse. We good, Emma?
Yeah, I think we're all set.
Cool. Okay. I mean, we're still talking about stocks anyways. But when I am looking at buying stocks, individual securities, equities, same thing, ETFs, exchange trade funds, okay, and listed closed-end funds. That's a mutual fund, but a finite amount of mutual funds, okay? It's about ownership, it's about control, and the stock is a claim on the part of the corporation's net assets and earnings. So you own those shares that you purchased until you sell them. So stocks are generally considered riskier investments than cash or GICs because their value can change rapidly, daily, like by the minute. So it's quick. But But the incentive is that they can offer bigger potential returns over the long run. And when I say bigger potential returns, I mean unlimited potential. Okay, but you got to pay a commission to buy or sell that, or you're going to pay a percentage of fees of your assets. That shouldn't be a deal breaker when you're buying a quality thing and you know why. Okay, you're only going to pay once to buy it, and you're going to hold it for years and years and years and years and years, right? And then you're like, okay, I've had enough. I want to take a little, sell a little bit because there's a lot of profit in there. Okay, we're going to sell a few shares. Don't let the cost of that decision be the deal breaker. Don't get and get emotional about it. It's just, there's a cost to do business. And usually people don't, it's not a deal breaker, okay? Because they want the asset and there's reward to it. So people start investing. I kind of enjoy this. I mean, the stock market's not new. It's been around a long time. Psychology's been around a long time. Analysts have been around a long time, and there's a pattern, and it's repeatable, right? And you can find yourself in there, and you start. Oh yeah, this is good. This is what I called that girl for. This is great, right? And then you see it, and you're like, oh, maybe it's too good. And it might just start to drop. You're making it, but it's not as fast as it was earlier. Oh, I gotta call Jen. Right? And long-term quality, right? And then going through and okay, call it over, really getting desperate in there. Like this is predictable stuff. This isn't the first time that people will have gone through this wave of emotions. And then, right, it comes back up and never had a doubt. That's why I called her. So it's predictable. Don't get too lost. I get paid to be in there, to work in there, right? And so as the investor, try to just live in a little bit more emotional bandwidth. That's hard to do because it's really exciting when you're making money, and then it can be a concern when you're losing it, especially if you can't afford it. And I should be, you have to have the tolerance for some risk if you're working with stocks. I got to know that. Because I'm the responsible one with the license, and I love doing what I'm doing, and I want to make the right decisions for the right people. But it's time in the market, not just timing it. And if you find yourself in this cycle, it's okay. It's going to end. It's going to get better. Okay, here's the next tool: hybrid equities. These are the structured notes. So, like I said, these used to be offered by only by major Canadian banks. And now independent advisors like me and my clients have access to them. Like I said, here's they offer downside protection, which I love. And there's no ongoing fees to the investor. The bank pays the broker or the brokerage, and then the brokerage pays me. So we get paid, but it's not from the investor. Okay, so the key features are that it's going to be, as in the investment, is going to be linked to a reference portfolio, which may include a stock or a couple within a sector, a handful could be, or ETFs, publicly traded baskets. And it could be insurance, it could be in pipelines, it could be in technology, it could be in utilities, right? There's all those different sectors. So I go through and look, and who's offering these? It's BMO, it's CIBC. I'm going in alphabetical order here. National Bank, Scotiabank, and RBC, right? And so I will look, we look what they have for the week. They don't last long. There's a short selling window for these. Look at the sectors, looking at the coupons. Coupons, interest bearing. But in a tax deferred account, who cares? Take the cash. Paying coupons, interest bearing. Okay, they have an automatic call feature. So the bank will call the note after a certain amount of time. Sometimes it's 3 years, sometimes it's 5 years, sometimes it's 7 years, sometimes it's 6 months. If the reference portfolio and the performance of that has gone beyond the boundaries of the note. Okay, and then if it does, and it's gone beyond that, and They call the note, you get your money back. You've received all of that cash flow through the month, every month. And then they say, oh, the bank called the note, and you get your money back. That downside protection, I love it, because it could be at least more than 20%. I want to give an example actually of a couple of notes that I'm looking at right now. Oh, this is kind of a cool one. Semiconductor basket. Okay, so it's attached to, I mean, you could go and buy the stocks for sure. AMD, Avgo. So we're talking advanced micro devices, Broadcom, Micron, and NVIDIA. I'm sure you heard of it. Anywho, but this is a basket. Okay, and you're signing up for, it could be as long as 5 years. Okay, and you're looking for 10.32% over the year, but broken up into monthly payments. Okay, so as long as that you're going to get paid monthly, plus it has the downside protection of 30%. So even if that basket of these semiconductors goes down by 30%, you're still going to get that same monthly income. So I love it. There's like a quantified risk, like the bookmarks here. You're going to get monthly income based on these details. So, I mean, there's pipelines, there's insurance, there's semiconductors. It takes an appointment, okay, to talk through all of these ones, but I love it. I'm noticing the time here. We're getting in here. Principal protected notes. These are similar products, but like in the name, PPN, principal protected, you can't lose your money. And there can be boosters or multiplication like rates, 170 times what the market index does. That really means 1.7 times the market. So if it goes up by 5%, 5 times 1.7 is 8.5. So it's a multiplier, and you can't lose your money, and it's a range of years. So again, I'm kind of blasting through PPN here, but I noticed the time, and I do have some case studies that I want to talk through. Do we have any quick questions?
Yeah, just one. Any thoughts on ETFs versus mutual funds?
Oh yeah. Yeah, I got lots of thoughts on that. I use them both. And ETFs really changed the mutual fund market. It challenged the mutual fund market because they're cheaper. So ETFs are typically, the brains behind those are computers. So they cost less, right? It's analytics and analogs that they're tracking. And you're just looking to get a piece of the market, not beat the market, just a piece of that. Oh, I want a tech ETF. You just want to get what that technology's index is doing. Or I want a bank ETF, or I want an insurance ETF. You're just getting a bite of that market. And you're not paying because no one's really pushing the cart. Mutual funds, there's a higher cost to have those because it's active management. Passive, active, brain, no brain. So they challenge the market in terms of cost, and in terms of psychology. Do you want to beat the market, or do you just want a piece of that market? I use them both. I hope I answered that.
Awesome. Thanks, Jen.
Okay. I got a handful. I'm going to blast through these, but no shocker here. We've got 4 pillars of life, and you can extend that. They mean even more in retirement. Okay, we need our health. Duh. We need our family. We need them. We need purpose in life. Don't retire too early. Keep your purpose. And we need some money, honey. So it's not new news, but looking at this, right, and keeping perspective, especially when we're employing people, right? People want to protect and enjoy their families, and we either work for ourselves or we work for a company. We need our friends, our community, and after our careers and retirement, extend it unless you have a clear plan of what your purpose will be, like volunteering or family or something to get up for, right? And we need some money. You can't avoid it. You need access to cash flow. Here's a quick reminder. Our largest asset in life is our ability to earn an income. It's not the size of your house. It's not your fancy boat. I mean, that's cool, but stay healthy so you can earn more. You want to earn more, work more. Okay. And largest expense in life is income tax. Accept it. It is. Oh, and also women typically live longer than men. So that's why I say, get control of your money, honey, because you're going to have a long time being the sole decision maker. So let's say that we've got a team of employees, or we want a team of employees, and it's a competitive market out there. And you know what people are saying? People want better benefits. Yeah, I'll work hard for you. I will hustle. I want more time with my family. I want less healthcare costs. I want to pay less tax. Okay, so 85% of employees rank efficient and affordable savings among the most important benefits an employer can provide. We got that. We got that a lot in Saskatchewan. Actually, every Canadian province has had access to Labour-sponsored venture capital corp funds. A lot of them blow it. Saskatchewan's kicking ass, and we have two. And you can invest in your company's payroll to help your employees by check help themselves. It's a benefit to them. It's affordable. It's easy. There's no cost to the employer. You set it and you forget it. You're saving, your employees are saving taxes on every paycheck. And it's a feel-good thing. You're investing in the local Saskatchewan economy. So more specifics about that payroll. It's 32.5% of tax credits. Plus, when they're contributing to that RSP, that's a tax deduction. So it's smart money. It's smart money. It lowers their out-of-pocket cost. It's affordable, and it comes directly off paychecks. It's kind of a no-brainer if you've got employees and you're investing in them and you want to invest in Saskatchewan at the same time. We've got people to help people to do that. And so I want to help women like you, because you know what, we are in an epic time. And specifically when we look at women coming into their own independence, their own asset, their own homes, their own power. So the future of finance is female, and it's pretty cool to be an advisor during this time. I love what I'm doing. 3 out of 4 women would like to have been more involved in managing their finances sooner. So getting professional advice is known to improve confidence. It's improving people's well-being and your financial resiliency, especially in a context of uncertainty. Okay, so studies confirm that those that work with an advisor and stick to the plan feel less stressed about money than others, and that this has a positive impact on the household financial resiliency. Duh. Okay, don't be overwhelmed or intimidated by the statements and the vocabulary. I mean, you can do it. We can do it together. But it does take a little bit of homework, right? And it takes time in being very, very real with yourself and putting the priority on the emphasis of your own financial independence. Okay, information's power, and you don't need to become an expert, just work with one, because professionals know more. So no matter what stage in life or investing, everyone needs financial clarity, and I love what I'm doing, and I want to help people make really confident decisions, because it helps. It helps today and it helps long run. So here's an example of someone in their 20s. Okay, a single mom. She's divorced. She's an employee. She's receiving a T4 and she's receiving child support. Here's some smart things that she's doing. She contributes to her TFSA. She contributes to an RSP. Okay, she used her RRSP as a down payment for a house. Home buyers program, it's a smart thing. You've got a long time to pay that back, and it's tax-free borrowing against yourself. Kind of a no-brainer. She uses GICs, mutual funds, no stocks for her. She doesn't have the risk tolerance for it. And because she also feels that she doesn't want to make a mistake or lose it. Not everybody has to use everything. Okay, safe, balanced, but squeezing tax credits out of old money, that's something that she's doing too. Who doesn't want a tax return, a higher tax return or tax refund? Okay, so that's Heather. I bet you there's a few of you that can relate to Heather. Okay, Heidi. Okay, single mom, business owner, divorced, was tempted when first starting that business and had some assets that she didn't pick, but they came to her. And so it was, you know what, I'm going to take out that money. I'm going to put it to use. I'm going to invest in myself. and start this business. And I said, sorry, I don't think that's a good idea. I think you should go get a business loan. No, no, yep, because it's taxable income when all this money comes out, and it'll just screw things up for years. So she got a business loan. And now the confidence is high because she's making money, her business is making money, and she has retirement assets that have grown and have not been touched. She's using old money to squeeze fresh tax credits out. So those tax returns come and she's in the money. She's using hybrid stocks. She's using mutual funds. Heidi has the tolerance for a little bit of risk. And so we work well together. And I watch for her. We get along great. Rita. Rita worked hard her whole life, buried her husband. She is a retired nurse. So her income is her husband's pension, her own nurse's pension, and then CPP and OAS. And it's amazing the amount of women that say, I never dreamt of having so much money. What do I do with all this money? You can invest it, spend it, give it away. A lot of people have modest lives, right? And they're like, well, what am I going to do with this money? And so it's tucked away to beneficiaries. It's invested to preserve it. Maybe, do I need more? I mean, who doesn't want more? But we protect it. We preserve it. And she doesn't exactly need to be watching the stock market, right? So I do that. GICs, mutual funds, the whole gamut out here, and maxing out her TFSA, because that can be a source of income for her when she needs it. There's also the benefits of having beneficiaries, right? To transfer tax-free. So estate planning, that's something that Rita and I have done a lot together. And I work with her lawyer, right? And I help her talk to my accountant, work as a team. Because I mean, I know a lot about tax, but I'm not an accountant, right? So I'll stick to my lane and I'll work with the other professionals for the synergy, for things to be efficient. Okay, here's my last gal here, Nicole, right? Common law married. Okay, one adult child and one tween. And her father had an incredible business, and the soul passed. And her brothers and sisters were lucky enough to receive an inheritance. So what do? You max out your TFSA, you max out your RRSP, you find tax efficient things to hold in your unregistered accounts. She didn't know what to do. You call someone, you talk to a professional. And again, here's the pattern. Yes, we are squeezing fresh tax credits out of old money, right? Year after year, we do that. So there's no one size fits all. There's no risk tolerance that suits everyone. Everyone's got different priorities and cares and beneficiaries and the reasons why. But it's these shelves of tools that I'm picking from specifically to suit what people need and their risk tolerance. Okay, how much time do I left? We're almost done. I have 2 slides left. Okay, this was from the first one too, but I think it's worth repeating. Work with professionals. Okay, work with an investment advisor, work with a lawyer, and work with an accountant. If anyone has gone through probate before, it's disappointing. It's expensive. There's delays. It's about control. Honestly, get a will. If you're just getting into a relationship, talk to a lawyer. Okay, those cohabitation agreements, they're just a thing. It's paper, right? To protect you. Oh, I don't have any money, just my group pension at work that I've built up over how long? He wouldn't touch that, or she wouldn't touch that. Yeah, get it papered, because things happen when unexpected life events come up. Have it papered, take control, work with professionals. So I feel like, yeah, here we are. This is how to get a hold of me. That's my cell phone. That's my email. I've got a website, Research Capital. And then I'm also on LinkedIn, so you can read about me there, but I'd love to hear from you. And so email me. I can't see anybody on the chat. So I don't know who's who in the zoo here, but I'd love to hear from you. And yeah, I want to hear what questions you have for me.
So we've got one question here.
Okay.
It's sort of a follow-up to the ETFs versus mutual funds question.
Okay.
How do you split your investment portfolio between ETFs and mutual funds? What's the ratio and how did you decide?
Uh, there's not a hard, fast rule for everyone. I mean, is the obvious answer. It depends how old you are. Depends what sectors of ETFs that you're looking at. If I'm looking at ETFs, I'm also looking at stocks, right? Because you're going to pay a commission to buy it. So ETFs are good for a bite of the sector, like I mentioned. So I like control. And so a lot of times I will just buy the stock or stocks. Okay. And as I will look at ETFs in particular when there's a big market correction. Because if you're just going to get a piece of the market anyway, go in when it's low, right? And the mutual funds are a big part of the book. I mean, they're one of the oldest tools. They don't have to be expensive, but in cases where it's either more modest amounts, or someone doesn't have the tolerance for those stocks, I don't know, 30–40% in a mutual fund, low risk, right? And that's just going to be a pedal that pushes things out no matter what the market does. Okay, of course, there's mutual funds that, you want all of the high tech in one because you don't want to go and buy all those stocks. Then fine, use a mutual fund. I can buy ETFs as well, but I like buying those at a low point in the market. Low. That happens. But again, those ETFs challenge the market because they trade like a stock. So you just buy them once. Okay, and shouldn't be any ongoing fee like there is with mutual funds. Anything else?
Yeah, a couple other questions.
Awesome.
If currently a biggest issue that someone is sort of facing is needing tax breaks, are
Yeah,
there other options other than RRSPs?
yeah, yeah. Liras. You can use a Lira account. Again, buying that Labour sponsored venture capital corp fund, LSVCC. Those are the easiest way to get 32.5% back. The maximum buy is $5,000 per year. This is a no-brainer that I can do. Okay, Labour sponsored funds. You buy $5,000, you get 32.5% of that back at tax time. Or if you owe less. Okay. There's more things that you can do in terms of contributions. I mean, donations, right, to different charities. To really get the most out of it, talk to an accountant. But as for the investing side, the RSPs, I mean, whatever you put in, you're going to decrease that, right, from your taxable income. So tax is usually going to be our biggest expense. So yeah, put money to those RSPs to deduct it. And then when in it, squeeze more out of it by using those Labour sponsored funds. Did I answer the question?
Yeah, I think so. Just one
Okay.
clarifying question. Were you talking about SaskWorks?
That's one of them. Yep.
Okay.
Yep. SaskWorks is one, and then Golden Ops is the other. We are so rich in Saskatchewan. We have two. Most provinces have had one and they blow it. We've got two and they sell out. So we should be grateful for them. We are, and I like hardly anyone says no. Do you like tax returns? Do you like money? People say yes. And you can do that like on a monthly payroll system as well. So employers can do that for their employees.
Awesome. Thanks, Jen. One last question here.
Yeah.
When does it make sense to reach out to an investment advisor? And should you reach out like at a certain once you reach a certain net worth?
I did say that, you want a bit of a sum of $5,000 to start, but that doesn't mean you can't call an advisor and get some advice. We're not paid by the hour, right? Like a lawyer or the dentist or fee, right? Like we can have meeting after meeting, right? And you might say, I don't think I'm ready yet to invest, but Jen has helped me prioritize, and now I got a budget, and now I know I need, to save 12 grand. So, I'm going to set a date. I want to save that 12 grand by December. Jen, I'll be calling you then, right? And staying in touch. So, is there, yeah, I mean, you can open a TFSA when you're 18. So it's never too early to get good advice. Put it that way. I hope I answered that question.
Yeah, absolutely. Well, I think that sums it up for questions. We did receive a nice message, no questions, but thank you for an amazing detailed journey through the options that will help women take control of our finances and give us
Oh,
power to make independent decisions around our funds.
oh, I love it.
Which, yeah, I think summarizes quite well
Aw, that's
everyone's sentiment.
wonderful.
So,
Yeah. No, I love what I'm doing. I am fascinated by this industry, and I get it. I know why it's important to help women control their money. I get it. And I'm highly motivated, and I have a beautiful office in Regina. I love having people in my office. So there's no cost to come and talk to me. Right? It doesn't work like that.
awesome. Well, thank you so much, Jen, for the wonderful presentation, and thank you to everyone who attended. Just as a reminder, we will be sending out an email tomorrow at noon with an on-demand version of this webinar so that you can always come back to it and give it another watch. If you're interested at all in learning more about crafting business plans, we do have a webinar next Wednesday on the 26th, again at noon. It'll be hosted by our own client services manager, Kara. So if you would like to register for that one, you can do it the same way that you registered for this one on our website, wesk.ca. Make sure to, jot down Jen's contact info and feel free to reach out to her or to Wesk at any time if you need anything. And yeah, thank you again, Jen. Thank you everyone for attending, and have a great afternoon.
Right on. Thanks, Emma. Thanks, everyone.